subscribe to the FASAB website, and they periodically issue information associated with what they're doing. And here was one, for example. It's called that third bullet, statement number 60 and the technical release on leases. So that's the technical release that they're issuing on leases. And basically what it says is that the board is looking at how to handle lease property, the value of the lease. How do you handle that? How do you book that? How do you show that in your records? That last bullet then also has implementation guides that are published by FASAB, and as well as practices that are widely recognized and prevalent in the federal government. So let's say that you got something that you're trying to figure out how to treat from an accounting standpoint, and you look through everything. You look through the standards, the interpretations, the tech bulletins, the technical releases. You can't find any guidance. Well, then it says, go to any other prevalent standards, which would include GAAP as developed by the FASB, the Financial Accounting Standards Board, or i.e. GAAP that was generated for commercial type operations. So that's what they mean here when they're talking about a hierarchy. You got to go someplace. You just can't make it up. You just don't make it up. Hierarchy of generally accepted accounting principles. All right. So in DOD, the entity that has financial management responsibility, obviously Comptroller, Undersecretary of Defense Comptroller, who, amongst other things, is the principal advisor to the SecDef and Deputy SecDef on fiscal issues. And he also wears a hat called the CFO, and that was based upon the 1990 CFO Act. But Mark Easton was the Deputy CFO, and he was representing DOD on a council that got established. It's called the CFO Council. As a byproduct of the CFO Act, every agency, there was a CFO Council that was established that meets monthly, and the council would be the representatives on that council are basically the deputy CFOs from the 24 major agencies. And they discuss issues associated with financial management in the federal government. So I said Mark Easton went to the Federal Accounting Standards Advisory Board to say, hey, I need some help on determining what the value of my asset, of my property, plant and equipment is. But first, they brought that issue over to the CFO Council, saying, I'm help. Does anybody here in the CFO Council have anything that would provide me with some assistance, me and DOD, some assistance associated with getting out of this problem? And ultimately, the result of that was, no, let's go to the Federal Accounting Standards Advisory Board and see if we can get a statement of standards or a standard change. Let's get that earlier statement of standards, that one back in 2003. Let's get that changed. And that's how SFFAS number 50 came to be. Now, the Undersecretary of Defense Comptroller issues the FMRs, Financial Management Regulations. And that's basically DOD policy regarding financial management issues. One of the things that I said to you earlier that drives some of this is OMB Circular A11 and OMB Circular A136. Remember, 136 was format, function of the financial statements themselves. Another thing that DOD Comptroller has the responsibility of is that for finance and accounting. And that's done through DFAS. So the head of DFAS works for, directly, if you looked at an organizational chart, works for Undersecretary of Defense Comptroller. And then DFAS is basically the the accountants, if you will, in the Department of Defense. And remember, I mentioned to you that the Treasury maintains the central general ledger for books government-wide. Well, in DoD, DFAS maintains the central general ledger for everything that goes on in DFAS. Now, there's another position, organization, that falls under the DoD comptroller, and that's DCAA, the Defense Contract Audit Agency. And by and large, amongst other things, they have the responsibility of, if there's a difference between a government, between a defense entity and a contractor or a vendor, the DCAA would be involved in reconciling those issues, reconciling those differences. Maybe it'd be a difference on what does a contract say? What's the specs? What's the requirements? And the vendor says one thing and the government agency says something else. These guys are supposed to work out the differences, the issues, basically auditing contracts, making sure that the contracts are legitimate, legal, etc. Now, let's see. So when it talks about that general ledger there, I just want you to write something behind here. Maintaining a central general ledger. What the general ledger does is clarifies financial transactions, puts them in categories as to assets, liabilities, income, revenue, and expenses. That's what's in the general ledger. Now the question is, why? Why do that? Well, here's the answer. They maintain that central general ledger to control, summarize, and report results. Control, summarize, and report results. How do we report results? Generating financial reports, financial statements. That's how you promulgate the results of your operations, what you're doing. Here are some additional guidance, information on different volumes of the FMRs that tell the financial management community how we treat things within DoD. So when we talk about FMR Volume 1, that's where we go to find general financial management information. Volume 4, accounting policy and procedures. 6A, I mentioned this one to you earlier, reporting policy and procedures. 6B, form and content. Mentioned that to you before too, of the DoD financial statements. Volume 9, travel policy and procedures. I seem to remember that I had a question on Volume 9. Which of the following volumes provides the guidance and information on travel policy? Volume 9. Then there are a few more, 11A and 11B, that talk about reimbursable operations. Now, reimbursable operations in general, between two direct funded type operations, you find procedures on that in 11A, but reimbursable operations that are done by a working capital fund, you go to 11B to find that information. And we briefly talked about non-appropriated funds before, different types of NAFs, and that would be Volume 13, accounting policy associated with NAFs. 14, very important one. Every federal agency will have formal written fund control procedures. That's our formal written fund control procedures, Volume 14. In fact, I mentioned that to you before, that when we're talking about ADAs, how do you follow, how do you investigate if you had an ADA? Who do you report to? When do you report? How do you generate the ADA documentation? That's all in Volume 14. Volume 15, foreign military sales, security assistance policy and procedures. And then the last one there, Volume 16, debt management, DoD debt management. So those are some outside things I guess you need to think about. Now, you might remember that in some of those two introduction PowerPoints, one of those bullets on there was talking about types of government funds. Now, again, and I told you we don't have a PowerPoint on it, but they are defined, explained in your course text on page 22 and 23, types of government funds. Now, I'm not going to go into a lot of detail except just tell you, by and large, your tax dollars, general tax dollars from individual citizens, those tax dollars, income taxes, go into the general fund, meaning they're not earmarked for a particular purpose. Now, let's say that we have Social Security and Medicare payments. Those would be considered special funds. They're earmarked. So any collections from your paycheck that are done every pay period by DFAS, those funds would go into a special fund, if you will, earmarked for a particular purpose. Then we've got these business funds. They call them enterprise funds, business funds, revolving funds. And there's two types. There are enterprise funds, i.e., where an agency runs a business type activity for the public. I gave you an example of that. Passports, dealing with the public, selling a passport, giving you a passport. There are also intergovernmental type funds, and that would be a defense working capital fund. By the preponderance of the work that a working capital fund does is with another DoD entity, another DoD agency. These, I think, if I would do this again, I wouldn't call this types of government funds. These are types of defense funds, because it says Department of Defense. I don't know why they put government funds in there. That's something that should be changed. But what do we have? Appropriated funds, the most common type, appropriated. And we covered, the 1 year, multi-year, no year appropriated funds. Then you've got reimbursable funds in DoD. That's where one DoD agency does reimbursable work for another agency. And you might remember that there was two basic authorities that allow us to do that. The basic authority goes all the way back to the 1930s, the Economy Act, where one government agency can do work on a reimbursable basis for another government agency. That's a general statutory authority. Then there are also specific statutory authorities, and in DoD, you might remember we talked about those as MIPRs, Project Order Authority, where, give you an example, industrial funds, air rework facilities, naval ship facilities, industrial fund operations, depots, Army depots to repair artillery, Air Force depots to repair aircraft, businesses. They were initially given statutory authority all the way back to, I think it was 1947, coming out of World War II. And that was specific authority to DoD to set up these industrial fund type operations. Now those have grown and matured into working capital funds. But the original authority for that goes all the way back to 1947. And that's Title 10 of the U.S. Code, Section 2248, way back 1947. And we've got revolving funds. Funds work like a for-profit business and sell products and services to a customer, revolving funds. That's where defense logistics can sell supplies, let's say, a revolving type operation. Trust funds, military retirement, trust funds. And by definition, the military, there are actuaries that would sit down and say, okay, we've got X number of military personnel. They're going to estimate that they work for a period of time. They're going to retire at a particular rank, and ergo, they're going to get a retirement check for a period of time till they die, let's say. And that's handled by these actuaries in this military retirement trust fund. And then the last one there was non-appropriated funds. And basically, we've pretty well talked about that before when we talked about the three categories, MWR type operations. Now, they talk here about categories of appropriations. We've already covered this, beat this to death with you, annual, multiple, no year. Now, under this permanent indefinite appropriation, you might remember I mentioned something to you about a revolving, judgment fund, a fund that was identified specifically in the Treasury for the Treasurer to pay judgments that are rendered against the United States. We initially pay them out of the judgment fund. Then the Treasurer turns to the agency who incurred the debt and says, reimburse the Treasury. And if the agency is dragging its feet to do that, Treasury has the statutory authority to unilaterally pull those funds from any available funds in the agency to restore monies back to the Treasury. So just make sure you know that we're talking what a judgment fund is. That's a permanent indefinite appropriation.
Sir?
Yes.
So under revolving fund and non-appropriated funds, it talks about the sale of goods and services. So what's the difference?
Well, revolving funds are appropriated. Non-appropriated funds are not appropriated. So a non-appropriated fund would be a officers club, enlisted club, bowling alleys, rod and gun clubs. Are you with me on that? That's not approps.
Tracking.
Appropriate, when we talk revolving funds, those are appropriated funds that are specifically identified to do work. And then, as it says here, to do the work and then be reimbursed by a customer using appropriated dollars from the Congress, being reimbursed to cover their costs of their operation. That's basically a revolving fund. And you might remember when Dave covered that with you, he said that there is, how do you generally, let me back up. This is kind of a funny story. My cousin was the comptroller at the now geospatial. Back then it was the Defense Mapping Agency. And they were in the business of moving from a direct appropriated funded operation to a revolving fund operation under this big umbrella called, in those days, the DBOF, Defense Business Operating Fund, which is now called the Defense Working Capital Fund. Same thing. And I remember sitting around at a Cardinals game one afternoon with him. And we were sitting there BS, and I said, "What's going on down there, Chuck?" He says, "Well," he says, "we've got to set up this our operation as a business." He says, "I've got to capitalize the business." And I said, "Well, what does that mean?" He says, "I don't know, but I got to do it." Well, how do you capitalize? How do you start a business? I don't care if you're going to start a mom and pop liquor store or gas station. You capitalize a business with money. You got to find some source of revenue to begin your operations. Like, I started a business, and it wasn't my original business, was a tax accounting business. And I needed money to start the business. So I went down to my local bank and I said, "Hey, listen, I need about 10 grand to start this business. Will you lend me, capitalize my business with 10 grand? And then I will buy computers, equipment, desks, office furniture that I need, pay for advertising, flyers, what do you call it, personal business cards. I need some money. And if they had loaned me that $5,000, think about that a minute. How do you journalize that entry? From a commercial accounting standpoint, I would debit cash when they gave me that loan of $5,000. I debit cash for $5,000. If you have a debit entry, you got to have at least one credit entry. And a credit entry would go to a bank loan payable, a liability. And then I'd have to pay off that liability as I went along, earn money. Now, the bank looked at me and said, well, come back in a couple of years when you've got some financial records to show that, you can do this, that you can pay back that loan. And I told them, I said, well, I don't need the money in 2 years. I need it now. And they said, well, we're just not going to loan it to you. So I took $5,000 out of my savings. Remember, I mentioned to you that I retired under Vera VSIP, and I didn't get $40,000. I got $20,000 left over after taxes. I got 16. So I had money sitting in my savings account. I went in and I took out 10,000 and I opened up a business account. That's capitalizing. That's taking money, putting it into the business, and then using that money to generate services, tax services, accounting services that I'd ultimately charge people for. They'd pay for it, and then I'd have that money to continue to work. That's where that concept, the idea of a revolving fund comes from. But you have to start it somehow. And we start it with a capitalization. That was the key thing, capitalization, revolving funds. I know that's a long-winded explanation of the difference between revolving funds and non-appropriated funds, probably more than you wanted to know. But the reason I tell that story is that I think it's very, very important. A couple of PowerPoints here. When I start showing you the proprietary and the budgetary entries for when the president signs an appropriation bill into law, how do we journalize that? How do we journalize that? Well, I'll get there in a second. Now, you've seen this PowerPoint before. There's really nothing new on that for me to tell you about. This is budgetary. Commitments, obligations, then we talk MIPers, we talk purchase orders, and then ultimately you pay for all that stuff. So basically this is just, remember I told you there's like maybe 3 PowerPoints where you're going to see budgetary information on it. That's what this is. It's all budgetary. This is a PowerPoint which shows you, and I mentioned this to you earlier, the Treasury issues general ledger account codes. And they issue them by series, numbered series. The 1000 series is where we use those general ledger accounts to record assets. Now, commercial accounting, the typical balance of an asset account is a debit. So let's say you're looking at your trial balance, and you find out that assets on your trial balance has a credit balance. Whoops, might be a problem there. That would mean that it's a negative asset. That's usually not a condition, a financial condition. Liabilities are recorded in the 2000 general ledger account code series, and they typically have a credit balance. So like the example that I gave you would be that loan from the bank. Debit, asset, cash, credit, bank loan liability. That's a liability. And if you have a debit account, you got to have at least one credit account, double entry accounting. They have to balance out. Now, the other example that I just mentioned to you, and that is I took money out of my savings account and I basically issued myself 100 shares of stock at $1,000 each for $10,000. Now, what was that journal entry? I debited cash for $10,000, and my credit entry went to net position, owner's equity. I owned $10,000 worth of this business. That's the worth. Sometimes they talk about this as net worth rather than net position. That's the worth of the organization. Now, the 4,000 series, those are self-balancing, meaning that you can see over there on the far side, it says both credit and debit normal. Well, that's because when you start with a transaction, appropriations realized, and that's a debit entry. Well, if you got a debit entry, you have to have a credit entry. Just think about that status of funds report, that SF-133. You got an appropriation. Now, that's a debit entry. We need to offset that. And the offset would be unapportioned. An unapportioned appropriation. It hasn't been apportioned to you yet. OMB hasn't given you your first quarter apportionment. I got a PowerPoint on that, a couple of PowerPoints I'll show you in a second. Revenue. All the sources that we have of revenue, the financing sources, basically taxes. That's where our revenue comes from, taxes. Expenses, general ledger account code 6000 for all the various expenses that we incur in the federal government. 7,000, the difference, either gains or losses I was telling you about, the bottom line from the difference between revenue and expenses. And the last one down there is where we capture information. We need to carry it someplace, but it's captured for explanatory purposes only. Like I'm going to show you something about stewardship land, let's say. We don't use it to run DOD, but we own it and we need to take care of it. So we're carry it in a memorandum account, the 8,000 series general ledger accounts. Let's walk through a couple of PowerPoints, and basically now I'm going to talk to you about that budgetary. So here's budgetary. So as I mentioned to you, what I'd like you to do on this PowerPoint is above resources here, put down DR. DR standing for debit. And on this side over here, put down CR standing for credits. Debits must equal credits. That's our self-balancing accounts. So if I ran a sum on what's in these two accounts here, they should equal what's in all of these accounts here. That's how you balance them out. Debits have to equal credits. So let's just take that very first line up there. Other appropriations realized, general ledger account 4119. So OMB, the president signs an appropriation bill into law. OMB says, okay, for that general ledger account, let's say it's ONM Navy. President signs the bill, $1 million. Debit entry. General ledger account 4119, $1 million. Now, if I have a debit, I got to have at least one credit. My credit is my unapportioned appropriation, and that'd be $1 million as well. As a matter of fact, here's an example of that journal entry. Right? Other appropriations realized, $1,000. The corresponding credit entry, unapportioned appropriations, $1,000. That's the first thing we do as soon as the president signs that appropriation bill. Now, let's say of that $1,000, OMB gives you your first quarter appropriation, $250. Well, now we have to reduce the unapportioned by $250 and increase the apportioned by $250. Therefore, the unapportioned balance would be $750. The apportioned would be $250. And by the way, these are both typically credit balances. So I've got $1,000, $750 plus $250 is $1,000, and I still have that $1,000 that was that appropriation that I realized. It's my debit balance. Then I'm in balance. And all we do throughout the use of that, as we move from apportioned to allotted, allotted to committed, committed to obligated, undelivered, obligated delivered, till the close of the fiscal year, then any balances in there move to anything that's still not obligated. It's going to move to an expired category. 5 years later, anything that's in that expired category moves to a canceled status. But all along this whole process, we still have a other appropriation realized account of $1,000. Okay? And we just keep recording it. Status of funds is what this is, the status of funds. Now, that's different than proprietary accounting. In proprietary accounting, we have, here it shows on a balance sheet, we talk about assets, and one of the, I guess, primary tenets of proprietary accounting is assets will equal. The sum of your assets will equal the sum of all your liabilities plus your net position. And I already told you assets are the 1000 series. Those must equal the sum of my liabilities plus my net position. This is that net cost equation I told you. We start with gross expenses. We reduce that by exchange revenue or earnings, okay? And that gives us our net cost of operations. So there's just a couple of proprietary accounts that they want to talk about. Now, that is it on PowerPoints for the next 4 or 5 pages out of the course textbook. So I'm just going to have to talk to you about some of this stuff, and you can jot it down here. But the only one I really want to bring to your attention is, how do you journalize the following transaction? The Congress appropriates and the President signs an appropriation act for $100 million for the year. Treasury issues a Treasury warrant. How do you go about journalizing that? Now, we don't have any PowerPoints on that, but you would have a budgetary entry and a proprietary entry. Now, OMB is going to handle the budgetary stuff. That's all of this stuff here. That's budgetary. OMB is handling that. Treasury is going to handle the cash issue through that Treasury warrant concept. So in my budgetary records, I would record other appropriations realized. Go back here. General Ledger account 4119, $100 million. And the contra entry to that would be unapportioned authority, $100 million. That's easy. But here's the one that I want you to think about. And unfortunately, we don't have a PowerPoint on that. What's the proprietary entry? I now have in my assets the authority to disperse, to outlay $100 million. That's my cash in the Treasury. Now, I told you there's not really cash in the Treasury. There's not $100 million of cash in the Treasury. You got your personal bank accounts. Think of it this way. You got a personal bank account. You go to the bank. You say, I want to see my money. Here, I've got my checkbook here, and it says I got $5,000 in my checking account. I want to see every penny of it. They're not going to open up a drawer with your name on it and say, well, here it is, count it and smell it. It's an arithmetic number. It's a bookkeeping number. You know, as a matter of fact, depending upon what your bank has as procedures, there is usually a limitation in terms of the money that you can disperse. And for that matter, there's also some time, depending upon the deposit you make. There'll be a period of time before the bank will allow you to start writing checks against that, because that deposit's got to clear the bank of the agency, of the business, of the person that wrote you the check. So what we got here is a paper balance of in the general ledger account of the Treasury, general ledger account 1010 of $100 million. Now, here's, I think, the important thing. What's the credit entry? The credit entry is a net position entry. $100 million to general ledger account 3101, which is unexpended appropriations. Appropriations received, but we haven't used them yet. We haven't used them. They're just sitting there. Remember I told you that when I started my business, I had to go out and take a $10,000 or $5,000 and dump it into my business? $5,000 in my bank account, $5,000 in my owner's equity account. Now, here's what I don't think people realize. The greatest thing that I think about proprietary accounting is whose money is that? That $100 million, who did that come from? You and me, as citizens of the United States of America, through our elected officials, through the tax dollars that we're paying. Those tax dollars are going to every government agency. Governments, mostly in and of themselves, do not generate revenue. Government, by basically virtue of what it is a transfer agent, transferring money from the populace in the form of taxes to the agencies that are going to do things for the populace that maybe the populace cannot do for themselves. They're transfer agents. A number of years ago, I did this class over in Naples, Italy, for Navy, and I decided that I was going to fly Air Italia. So I flew out of Chicago International Terminal, and I'm standing in line to get on a 767 with 249 of my brand new Italian friends, 250-seat plane. 249 people, Italian, rich arms. And these were people, Italian citizens, that had come to the United States a week, 2 weeks, a month, spent all kinds of money. And now what they were doing was standing in line to get on a plane to go home. They had been vetted when they came to the country. They came into the country, they were cleared. They had to go through customs and immigration. They spent their money, and all they want to do now is take all the junk that they bought, get on a plane, and go home. I was embarrassed as an American citizen. I was embarrassed the way the TSA people were treating our guests, our tourists, that all they wanted to do was get on that plane and go home. Screaming at them about stand in line, screaming at them about take their shoes off, screaming at them about doing this and doing that. Now, I've had my experiences with TSA over the years. And one thing I've learned is I always keep my mouth shut until I get to the other side. When I get through all of their little silly stuff, I get to the other side and I ask one of the agents there, I said, I'd like to speak to the person in charge. Some lady comes up and she was just the head shoe sniffer. And I said, no, I want to speak to the person in charge. About 5 minutes later, a guy shows up in a nice 3-piece pinstripe suit. And I said, come here a minute. I said, look at this. Look what's happening over here. I said, look at the way your employees are treating our guests. And I went through the whole drill. I said, these people came in. They were all cleared. All they want to do is go home. And man, you're making the whole event miserable. Your people are. They kind of looked at me and said, well, who are you? And I said, I'm your boss. I own you. Your salary and the funds to run your operation are coming from me and 150,000 or 150 million other people just like me. I said, don't forget that. I said, you work for us. That's why I just love that journal entry. People don't, if for any reason we're doing proprietary accounting, that ought to be it. That ought to be it. All right. They've got a group of, they could ask you questions if you thought about it on assets, liabilities, net position, revenue, and expense. But they concentrated on assets. So on this PowerPoint here, there are 2-3 questions of issues in the exam. The first is the fund balance with the Treasury. What is that? Well, number one, I told you that was General Ledger Account 1010. And it's the aggregate amount of funds that an entity has at the Treasury that you can make payments against, disbursements, outlays. That's what's in that account, General Ledger Account 1010. And how do you get that in there? When the Treasury issues a Treasury warrant. Now, assets are reflected on the financial statements on the basis of liquidity. The most liquid asset is the first, all the way down to the less liquid asset. Well, fund balance, cash in the bank, that's liquid. That's available to pay your bills. Now, there are situations where, just like in your personal bank statement, that you make deposits or you wrote checks and they haven't cleared the bank yet. Well, who is our banker? Treasury. Are there deposits that we make that we record in the DFAS records that haven't cleared Treasury yet? Yeah, sure. There's payments that we made that haven't cleared Treasury yet. And that's what these undistributed disbursements are. They're federal government funds that have been paid, but for whatever reason have not yet been identified against a specific appropriation. I don't know if you're familiar with the term NULOs, negative unliquidated obligations. You know what that says? A negative unliquidated obligation. That means that you paid more than you had available in your appropriation. That ain't right. You know that's wrong. So we do a reconciliation on that stuff. We can't process that against our bank account because it wouldn't balance if we did. So you need to know what that is. Now, since those deposits, or in this case, disbursements, haven't come out of your account in the Treasury yet, that's a less liquid asset, put it that way. Interest funds, petty cash funds. You used to have a lot of those, don't have them anymore, because now you're all running around with GPCs, government purchase cards. Oh, by the way, I meant to tell you something, and that was somebody asked Dave a question about pay and chase. And I kind of alluded to that when I was talking about the GAO doing an audit out at SPA War, whatever you call it, and found that there was one certifying officer for over 1,700 government purchase card holders. And he was certifying, making a payment to the bank, and then chasing down whether or not those payments were legit. And for that is on GPCs, government purchase cards, is if you pay in a timely fashion, they give you a discount. So if they send you $1 million bill, and if you pay within 15 days, you get a 2% discount, we pay and chase. We're going to pay that bill because we're going to take that discount, and then we'll worry about if it was accurate later on. Now, we used to do all that stuff, not with these GPC cards or travel cards. We'd have this petty cash fund, interest fund. And you still have some on the ships. We have, years ago, we were up at these meetings up in D.C., instructor meetings, and a guy came over in 06, I think it was Army, and he was the responsible for handling walk-around money in Afghanistan. Walk-around money. What's that? Well, you've seen those pellets of $20 bills and $50 bills. And when a squad leader would go out before walking around a corner, there might be some kid sitting there, and he'd say, "Hey, what's around that corner?" The kid would say, "Give me $50, I'll tell you." take out $50 and give them to him. That was an interest fund. And this guy was saying, it's a nightmare. He says, there's just no control over it. I know how much we sent over there on a pellet, but I can't tell you where it went. It's just part of doing business, part of doing the war. And the last one down there, travel advances. That's a big one. Now, again, used to be that we gave you, oh, let me back up, accounts receivables. Forgot that one. What's an accounts receivable? Where one entity does work for another entity, and the other entity hasn't paid yet. That's an accounts receivable. Something that you've done, work that you performed, that you're due a payment on. But since you haven't received the payment yet, it's not available to be deposited into the treasury, and therefore it's not available to make a payment yet. Then advances, basically there they talked about travel advances. Dave mentioned something to you about the payment advances to contractors, small contractors. That would be taking the cash, moving it someplace else. Ergo, it's no longer available to you. I mean, you could call it back, the advance back. Cash would go back into the treasury. Now, remember I mentioned to you about Rumsfeld and that one SFFAS, and Rumsfeld said, well, we will treat all capital purchases as depreciable items if they meet some certain capital thresholds. Number one, it has to be tangible. Okay? Something I can touch, something I can hold. Goodwill is not touchable, tangible. Secondly, it has to have an estimated useful life of 2 or more years. If we buy something and we figure that we're going to use it, blow it up, destroy it within a year, we expense it. Write it off as an expense of that particular year's operations. If it's going to be around for more than 2 years, then you depreciate it on, you might want to just jot this down, on a straight line basis. We have to use straight line depreciation. You can't use accelerated, double declining balance, whatever. You have to use straight line basis. Third, it's a capital asset if it's the thing that we're going to buy is not intended for sale, resale. Pine Bluff Arsenal down in Pine Bluff, Arkansas, is the sole industrial site, Army site, that manufactures hand grenades. They sell them. They're building them, manufacturing them, sticking them in inventory and selling them. That material is not intended to be depreciated. Some of those hand grenades might be sitting in inventory for 5 years. We don't depreciate them. We just carry them in there as a inventory. It's an asset, but it's inventory. It's not a capitalized asset. Fourth bullet, they're intended to be used or available for use by the entity. This old accounting instructor I had from 1,000 years ago, he says, you don't buy an asset to put it in a corner and look at it. You buy an asset to make money, to help you run the business. Well, tanks, ships, planes, we buy them to help us fight the war. And therefore, we need to capitalize them, depreciate them. Now, the bottom line depends upon the entity. Army, Navy, Air Force. They all have different capitalization thresholds. Again, each military department sets the capitalization threshold. Now, how do you determine what the dollar value of the asset is that you're going to put on the books and depreciate? What makes up the purchase price is what I'm trying to tell you. You need to jot this down someplace. Okay, so the acquisition value, the purchase price of an asset, consists of the amount paid, transportation, installation, and other related costs of obtaining the asset and preparing it for use. Hookup, power supply, building a steel concrete reinforced pad to put it on. It's all part of the dollar amount, the purchase price, the acquisition price that we are going to depreciate. All right. I mentioned to you, we don't have a PowerPoint on it, but I mentioned to you about that GLAC General Ledger Account Code 8000. And I said that that's our memorandum of accounts. And things that we would put in that memorandum account are items that the Defense Department owns, controls, holds for future generations, does not use to run the operations in DOD. Like if you went over to Hampton Roads and you went to Fort Meade, no, not Fort Meade, there's Mason, I don't know, whatever that Army Fort Story, was that it? I don't know. There's an Air Force base over there in Hampton Roads, and there's an Army facility. And on that Army facility is a old Civil War jail cell that I guess it was Jeff Davis was imprisoned in after the Civil War. And the Army has that on its records. The Army's not using that building to fight a war, but the Army's responsible to maintain that. Okay? And that would be the kind of stuff that we would call a heritage asset that we would record in that General Ledger Account 800. We don't put it on our books. It's in our records, but it's not going to, in fact, if you went to those financial statements for 2021, there'll be a supplemental report in there that will talk about heritage type assets. There are 3 things I need you to write down. 3 things. So even if you were in a classroom setting, I tell you, write these down someplace. It's not in your book. First one, if the purchase price is not known, estimates of the cost can be used. If the purchase price is not known, estimates of the cost can be used. How do we come up with the value of the assets back there in 1997, fiscal year 97? We went to GSA. We said, hey, what do you think you got? We got. They shot us a number. We estimated it. Second thing, for fixed assets, the amount expected to be recovered from an asset disposal is called the residual value. So let's say we bought something for $100,000. We're going to sell it. And it's got $50,000 of depreciated value. Therefore, it's got a net residual value of $50,000. And that's what we would anticipate that we could sell that for. Third thing, excess, obsolete, and unserviceable inventory should be valued on the financial statements at net residual value. In other words, you're going to have to write them down to a price level for bookkeeping purposes of what you think you could sell them for. Net residual value. Now, we don't have PowerPoints on these 4 DoD financial statements, but in the course text, there's a sample of the 2018, 2019, 2 years of, of information for balance sheet, statement of net costs, that was gross cost less any earned revenue equals net cost of operations. And it's the net cost of running DOD that we have to cover with bonds, cover with the revenue that we generated through those appropriations. So our primary source of revenue is appropriations realized, general ledger account 3100, 3107. And as we incur expenses, we're going to have to take some of that revenue that we reflect in that net position account, and we got to move it over to our statement of net position, our income statement, if you will. And that becomes the revenue that we would use to be able to cover the expenses that we're going to incur. Okay? Now, there's two things I need you to write down on here that is data information associated with the balance sheet. There's just a couple of questions I want you to write down. First, the basis for recording accounts payable. The basis, BASIS, for recording accounts payable is. Now that's what's on a balance sheet, remember? Our payables, those are our liabilities. So what's the basis that we use for recording accounts payable? Receiving reports, showing the quantities received and accepted. Dave mentioned that to you at the very beginning of dispersing finance. Talked about it's not just a receiving report, but it's also a statements of exception. Now, once we get that, we owe the vendor. That's the basis for us recording a accounts payable. Accounts payable. Second thing. Receiving reports, court decisions, and estimates of accrued liabilities. Military retirement, that's an accrued liability, are all documents that support our liabilities. So one more time, receiving reports for goods, court decisions. A court says you've got an EEO grievance and you've lost it, Navy. We have to record that in our books at the estimated dollar amount of that court decision. And then, as I mentioned to you, military retirements. Those are liabilities as well. We have to list all of those. Those are all examples of the things that we would show as a liability. Okay. Managerial cost accounting, where the treasurer back in 1996 was given the responsibility, statutory guidance, statutory responsibility to build a managerial cost accounting system. Now, that is the procedures on that, the process of doing that were spelt out in Statement of Federal Financial Accounting Standards number 4. And basically what it's saying was, look, if we're going to build a cost accounting system, you have to know what the full cost of that function is. And the full cost of the function includes direct cost. Now that's easy. You know, let's just say that I'm in DFAS and I want to try to figure out how much I'm going to charge you to handle, to pay, and record one travel voucher payment. And I've got Billy Bob sitting out here in the shop processing the stuff. And it's going to take Billy Bob 1 hour to process the travel voucher computation payment. And Billy Bob makes $20 an hour. Direct cost. Boom. By the way, Billy Bob might very well use a piece of paper, a voucher of some type. 5 cents. Materials. Boom. I also have to consider the indirect costs associated with Billy Bob, with that process. And that would be Mary Jane, Billy Bob's boss. Overhead. We have to figure out what that is. Oh, by the way, Billy Bob, when he's doing this, has got a calculator that's going to consume electricity. How much electricity do we use in there? That's overhead. How about the square footage cost associated with air conditioning, electric? But again, you got all of this overhead cost, and maybe it is Billy Bob's desk, his cubicle, and we figured out that during that period of time, that 1 hour, he consumed 10 cents of electricity. Boom, indirect costs. Now, where it gets tricky, before I get there, then you have intra, within the agency, intra-entity costs. So, that's within the Navy, and we ought to be able to pull that stuff together fairly easy. So, somebody over in HR is handling Billy Bob's retirement records, is handling Billy Bob's personnel records. Somebody in the payroll shop is handling Billy Bob's pay. We got to pull those costs as well. See, I'm in DFAS, and I got to tell, I'm about DFAS, and I'm part of this working capital fund. And I've got to tell Navy, for every transaction I process for you for travel, this is what it's going to cost you. I'm trying to build that number right now. So G&A costs. Now, the ones that are kind of tricky are these inter-entity costs. Costs for goods and services received from other entities, including other entities outside of the agency. Inter, one entity to another. So let's say, as I mentioned to you, OPM is doing something that can be relatable to Billy Bob's costs. You are I heard Dave say something about that when they evacuated for Hurricane Katrina, he went down to that base just north of Memphis, whatever that is now. I can't remember what it was anymore. But on that facility, which is a naval installation, there is the Army Corps of Engineers finance office. Army Corps of Engineer finance office is down there. And they, I would imagine, have to determine what the cost, because that finance office, again, part of DFAS overall, they've got to determine what the cost of handling one travel voucher computation down there would be. Well, that building facility that they're in down there, is the Navy giving it to them for free? No, we talked about reimbursable agreements. Remember, there can't be any, the only thing you can bill is for incremental costs. Well, that building was sitting vacant, now it's not. So again, that would be where the Navy may very well wind up billing the Army Corps of Engineer DFAS operation down there for some cost that would go back to that one travel voucher that Billy Bob prepared. Now, I want you to write something down over here on the side. You might put a little bracket in there. And I want you to write down that these are commonly referred to as imputed cost, INPUTED, imputed costs. That's what these are. Last subject in accounting. They talk about ratio analyses. We are so mechanized today throughout the world, federal government as well, that generating these financial statements, I mean, you've got data that goes in the front end, and then maybe it's a person that puts that data in the front end, then everything else is automated, and what gets spits out the back end is an automated financial report. That could be budgetary, status of budget, status of resources, or proprietary, budget, balance sheets, income statements, etc. I think the people that are worth their weight in gold are the people who can look at this stuff and analyze what it means. So there's just two, and these are people that can do analyses. And one of these might be ratio analysis, where you look at certain general ledger accounts, cash, accounts receivable, inventory, and you want to say, well, of this cash, accounts receivable, inventory, I'm in a working capital fund. I'm assuming, you know what assume means, right? I'm assuming that inventory will be sold, will turn into a accounts receivable, and a customer will ultimately pay me, and it'll become cash. And now I am assuming I'm going to have enough cash to pay my current liabilities. Now, what this means when we talk about current liabilities is bills that I have to pay within that operating year, 1 year. So I'm saying, am I going to have enough cash over this 12-month period of time? How do we generate our cash? From selling inventory, setting it up in accounts receivable, and then getting paid. Do I have enough cash when I do that to cover my current liabilities? And they say that a good ratio is 2 to 1. Yeah. That's what? Based upon what? Based upon history? Based upon industry standards throughout the federal government? Based upon my entity's records? I don't know. But, they just came up with 2 to 1. But the key thing here is to remember what makes up the numerator. That's cash, accounts receivable, and inventory, divided by current liabilities. So they're simply saying, you should have $2 of cash coming in to cover your current liabilities. Now, there's something that's also called the quick ratio. And you'll notice here, they take out inventory. And what they're saying there is that maybe your inventory isn't going to sell. I don't know what it looked like maybe in the areas that you all live in, but here in the St. Louis area, when the economy crashed in 2008, I could drive down darn near any major thoroughfare in St. Louis and I'll find one closed auto dealership after another. These guys, when they were humming along, selling cars right and left, they might have literally 1,000 cars out on their lot. They had to pay for those cars. I mean, they had some outstanding mortgages, outstanding bills loans that they had to pay to get those cars on that lot, under the assumption that that inventory would sell, that would turn into an accounts receivable, that would become the cash that they needed to pay their bills. Overnight, the market crashed. People had no money, cars didn't sell, and they had assumed from their ratio analysis and their previous history that everything would just continue to operate as it did. And then it didn't. Sales dried up, disappeared. And all of a sudden, they didn't have enough cash to cover their bills, their liabilities, their current liabilities, the stuff they had to pay for in 1 year, disappeared. So again, the thing you need to take away from this is, on a quick current ratio or a quick ratio, you do not consider inventory. And that's it. That's accounting. So why don't you go ahead and take a 10-minute break,